In this particular session, we are now to start talking about your business combination. Last session, we already have an introduction regarding the subject, particularly business combination. But right now, we will talk about the intricacies of business combination, its recognition, and its measurement. So when do we recognize a transaction as a business combination, and how do we measure business combination? So at the end of this particular session, we should know when do we have a business combination and how do we measure a business combination. Business combination is defined as a transaction or event in which the acquirer obtain control of one or more businesses. So if ever a transaction has the substance of getting control over one or more businesses, it is known as your business combination. So take note, when we talk about your business combination, there must be a control. So what is control? Control is defined as controlling the financial interest by ownership of a majority of the voting shares of stock. The general rule is that ownership, either directly or indirectly, by one company of more than 50% of the outstanding voting shares of another company constitutes control. This definition is one-sided because here we only look as to the control pertaining to stock acquisition. Because of course, you can only measure the control if you own shares of stocks. Take note guys that if that is a stock acquisition, generally to get for the ownership interest, we compute by getting our shares owned divided by the outstanding common stock of the company. So take note guys, ownership of the shares of stocks can only be equated to ownership based on ordinary shares. So control is only present for ordinary shares. There is no presence of control if you own preference shares. That's why if we look at our formula here, our shares owned on common stock, we divide it to your outstanding common stock. So the ownership or control is tested only based on your common stock or ordinary shares, but not on preference shares. Okay, so take note of this. If we try to test for the 50% control, we test it based on common stock or ordinary stock, not on your preferred stock. So long as there is a control of one or more business, there is already a business combination. But take note, in a business combination, it is either owned directly or indirectly. Owned directly or indirectly. So for example, a company purchase stocks on X company. A company also owns D company. So A company purchased 30% of X company. A company owns 100% of D company. Okay? So A purchased X company 30%. A purchased D company 100%. Also, D company has 30% shares on X company. First question, A, does it control D? Let's go back to our definition. The general rule is that there must be 50% outstanding voting shares. When we talk about voting shares, that is common stock. Therefore, does A control D? What is the ownership of A to D? 100%. Is that more than 50%? Yes. Therefore, there is control. Next, does A control X? Does A control X? Take note. When we look into the more than 50% ownership, take note of the words used, more than 50%. So it is greater than 50%. It is not 50%, it is more than 50%. So whether directly or indirectly, what is directly owned by A? A owned 30% of X. What is indirectly owned by A? If A owns D 100% and D owns 30% of X, in short, A also owns another 30% of X. Okay? A owns D 100%, D owns X 30%. Okay? A owns A owns D 100%, D owns X 30%. In short, A also owns X another 30%. So A 30%, which is the direct, A to X 30%, and then we have your indirect, which is A to D to X indirect of another 30%. So what is the total? 60%. So the total ownership, therefore, is 60%. Since the total ownership now is 60%, is that more than 50%? Is that more than 50%? Your answer is yes. It is more than 50%. There being more than 50% ownership, there is the presence of control. So the first one is direct, A to X. The another one is indirect. Okay. So normally that happens in a conglomerate. Normally that happens in a conglomerate. So you already know how to compute for your what do we call this one? Conglomerate ownership. Take note, guys, it is more than 50%. Therefore, it is not 50%. It is not equal to 50%. Why? Because if it is 50% only, you are exercising joint control. Generally, you're exercising joint control. What do we mean by joint control? Perhaps one entity own the other 50% and you own the 50%. So having both 50%, you have joint control. When we say control, you only have the right or the only interest that can control the entity. In this case, if it's both 50%, you are having joint control. That's why what is presumed is more than 50%. Again, whether direct or indirect. Okay, let's have another example regarding your direct or indirect. Okay, I'll just erase this. So A owns B and C, 30%, 100%, I know, 90%. C owns B at 70%. Okay? And then C also owns D at 80%, and D owns B at 30%. Okay? A owns B at 30%. A owns C at 90%. C owns B at 70%. And then D owns B at 30%. C owns D at 80%. Okay. So what is the ownership percentages of A as to B, as to C, and as to D? If we try to look at it, kay C, isa lang naman yung linya niya. Isa lang yung linya ni C. Tama? Ano lang yung linya ni C? A owns C 90%. Let's place that as red. Okay. So A owns C at 90%. So the percentage of ownership of A to C is 90%. Now, as to ownership of A to B, if we try to look at it at B, let's change the arrows into color green. Okay. So for B, we have a direct ownership A to B at 30%. Next, we have indirect ownership. We have indirect ownership, which is 70% of C to B and 30% of D to B. Actually, the percentages is more than 100% already. Let's change it. So let's say this is 40%. Okay. So C owns B at 40%, D owns B at 30%, total of 100%. So who actually owns B? So A has the direct ownership of 30%, C has the direct ownership of 40%, and D has the direct ownership of 30%. Now we need to get for the indirect. Since we own C at 90% and we have 40% out of B, okay? How much then is the ultimate ownership of A out of B? Again, C owns B at 40% and we own 90% of C. So we have also 90% ownership over B. So that will give us 0.9 times 0.4, we have 36%. Another indirect ownership is that we own C, right? We own C, 90% of C. And then C owns D at 80%, right? A owns C at 90%, C owns D at 80%, and D owns B at 30%. So what is the ultimate ownership of B? 0.9 times 0.8 times 0.3, the ultimate ownership of A to B is 21.6%. So how much is the total direct and indirect ownership? 30 plus 36 plus 21.6, we have 87.6%. Okay? So we have here direct and indirect. Let's, so that you will understand it again. For the direct, what do we have? A owns B at 30%. For indirect, A owns C at 90% and C owns B at 40%. Another indirect is that A owns C at 90% and C owns D at 80% and D also owns B at 30%. So what do? We just get for the net indirect ownership. So we just multiply it. 90% times 40% is 36%. 90% times 80% times 30% will give us 21.6%. So what is the total ownership interest? Direct of 30, indirect of 36, and indirect of 21.6. Total ownership interest is 87.6. How about on D? What is our ownership on D? Do we have any direct ownership on D? Is there A to D? None. There is no direct relationship between A and D. How about an indirect relationship? Do we have an indirect relationship on D? Yes. We have A to C to D. So A to C to D, A owns C at 90%, C owns D at 80%. So what is our indirect ownership over D? Our indirect relationship over D is equal to 0.9 or 90% of 80%. So that will give us 72%. Our indirect relationship on D is 72%. So here, although there is no direct 50% ownership, if we try to compute, we can get more than 50%. Okay? So that is as to assessing whether there is a control or no control. We go back. There is control if it is presumed that we have more than 50% ownership. How do we test that more than 50% ownership? Based on the outstanding voting shares to the another entity or company. What is that outstanding voting shares? That outstanding voting shares is based on your common stock. So we will just get the ultimate ownership interest out of that particular company. Okay? Since we are already on the part of your acquirer who obtains control of one or more business, and we're done with your control of one or more business, what do we call the acquirer and what do we call those companies that is owned? So in our example here, we have A as the acquirer. And since A owns B and C, these are your acquiree. So who is an acquirer and who is an acquiree? An acquirer is known as the entity who obtains control over the acquiree, while the acquiree is the business being acquired. It is the business being acquired. Okay? So in a business combination, there is a transaction or event in which we obtain control. So if ever we purchase one business and we purchase more than 50% of that business, there is a business combination. And take note, in looking whether there is control or there's no control, we look whether the ownership is direct or indirect, and we get the total ownership interest. We proceed now as to the methods of effecting business combination. So how do we effect your business combination? There are two methods of effecting business combination. So we can purchase a business, purchase or acquire a business using these two methods. And what are those? That can either be an asset acquisition or stock acquisition. So what do we mean by an asset acquisition? When we say asset acquisition, it means that we purchase the net asset of one business. So what do we mean by net asset of one business? When we say net asset of one business, that is asset less liability, meaning we acquire all the assets and liabilities of one business. So what will happen? If A will acquire B and we purchase all the assets and liabilities of B, what will happen to B? B will now be absorbed by A. So in short, since you acquire all the assets and liabilities, all represents 100%. Therefore, there is a business combination. Just take note, in asset acquisition, it is always 100% purchase. It is always 100% purchase. In your stock acquisition, we purchase the stocks of a business, which gives the acquirer control over the acquiree. Okay? So in stock acquisition, this is the investment in stock. And your investment in stock is more than 50%. So you purchase more than 50%. Okay? So here in your asset acquisition, what do we purchase? The net asset. In your stock acquisition, what do we purchase? We purchase the stock. We purchase the stock. So how do we account for business combination? We already know what is a business combination and how does your business combination happen. So business combination, again, there is business combination if ever a transaction or event, there is a transaction or event, and the acquirer obtains control over the business. And how do we affect that particular business combination? If ever it is an asset acquisition or a stock acquisition. Next, our problem is your accounting for business combination. So how do we account for that business combination? We use the acquisition method in accounting for that business combination. And how does your acquisition method works? First, we identify the acquirer. So who is the acquirer again? The acquirer is the entity that obtains control over the acquiree. So it is important for us to know who is the acquirer. Why? Because only the acquiree net assets are revalued at the date of acquisition. So at the date of acquisition, we have here your acquirer and your acquiree. So whatever is the net asset of acquirer, it will remain at book value. Only the net asset of the acquiree will be revalued at fair value. That's why we need to know who actually controls the other. So take note, the acquirer is the one who controls the other. So whoever actually controls the other will remain its net asset at book value, while the one being controlled will be revalued at fair value. Okay? So in accounting parlance, normally the acquirer is the one who transfers consideration to another entity. Okay? The acquirer is the one who transfers consideration to another entity. So the one who purchases is the acquirer. Next, the acquisition date. When is the acquisition date? The acquisition date is the date when the acquirer obtains control on the acquiree. Okay? The acquisition date is the date where the acquirer obtains control over the acquiree. When is that? Of course, at the time of acquisition, at the time you purchase it, at the time you transfer consideration. Why do we need to know the acquisition date? The acquisition date must be known so that we know the date that we measure the fair value of acquiree's net assets, because it is also the date that we need to remeasure the fair value of your acquiree's net asset. After step letter A and step letter B, we go now to step letter C. What is the step letter C? We recognize and measure identifiable assets acquired, liabilities assumed, and non-controlling minority interest in the acquiree. So what do we recognize here? We recognize the assets that we purchase out of one entity. So remember, A, business combination with B. If A is the acquirer and B is the acquiree, we acquire the net assets of B. So that is your asset less your liability. Okay. If that is an asset acquisition. If that is an stock acquisition, aside from net asset, that is asset less liability, we also recognize the non-controlling interest. So this happens during stock acquisition. Third question, what is a non-controlling interest? Remember, if you purchase, we only need to look at control. And control means more than 50%. So what happens with the excess? So assuming you purchase 75%, okay? You purchase 75%. What is the excess? 25%. The excess of the ownership interest is known as your non-controlling interest. Again, in your stock acquisition, we measure all of these items: the asset of the acquiree, the liability of the acquiree, and the non-controlling interest. So how do we do it? So at the date of purchase, you look at the ownership interest purchase. So for example, we purchase 75%. So there is an excess ownership, and that is 25%. The 75% represents control. We call this one your controlling interest. How about the remainder, which is 25% or the excess? It is known as your non-controlling interest. Okay? That happens on a stock acquisition only if non-controlling interest is present if the purchase of stock is not 100%. It only appears whenever the purchase of stock is not 100%. Okay? So take note in your recognition and measurement, what do we recognize? And what do we measure? We recognize the assets and liabilities, including non-controlling interest of the acquiree. When is there non-controlling interest? Only during stock acquisition. If that is an asset acquisition, we do not have non-controlling interest. Okay? And non-controlling interest is only present if the purchase of the stock is not more than 100. If the purchase of the stock is not 100%. In short, it is lesser than 100%. So in our example, we only purchase 75%. Therefore, the excess of 25% is considered as non-controlling interest. Okay? And the last step for our acquisition method, we recognize and measure goodwill or recognize a gain from a bargain purchase. So when do we recognize and measure goodwill, and when do we recognize a gain from bargain purchase? So we already said that the acquirer will purchase the acquiree. So let's say A is the acquirer, B is the acquiree. So this purchase is known as whatever is given to B on the purchase is known as your consideration transferred. And whatever is purchased in B is known as your net asset. So to know whether there is a goodwill or a bargain purchase, we compare the consideration transferred to the fair value of net assets acquired. Okay, so this is your net asset acquired. So A will purchase B. A is the acquirer. B is the acquiree. So B is the business that is acquired. So what do we do to know whether there is a goodwill or a bargain purchase? To know if there is a goodwill or bargain purchase, we compare the consideration transferred to the fair value of net assets acquired. If the consideration transferred is greater than your fair value of net assets acquired, we have a goodwill. But if the consideration transferred is lesser than your fair value of net assets acquired, we have a gain on bargain purchase. Okay? So again, in acquisition, the acquirer will give consideration to the acquiree. So the consideration transferred by the acquirer to the acquiree is known as consideration transferred. And whatever is purchased by the acquirer to the acquiree is known as net asset acquired. So we need to compare the consideration transferred and the fair value of net asset acquired. If the consideration transferred is greater than the fair value of net asset acquired, we have a goodwill. But if the consideration transferred is lesser than the fair value of net asset acquired, we have a gain on bargain purchase. Perhaps you're asking me, sir, a while back we only said net asset acquired. Why is it now fair value of net asset acquired? Take note, at the time of acquisition date and at the time we determined the acquirer, we said a while back that the acquiree on its net asset it must be remeasured at fair value. So this net asset acquired will be remeasured at fair value. So we just measure the fair value of the net asset acquired. Okay? So again, acquisition method, we identify the acquirer, the one who controls the acquiree. We determine the acquisition date, the one or the date wherein we had control. And letter C, we try to recognize and measure both net assets acquired and non-controlling interest. Take note, non-controlling interest or NCI or minority interest is present only during stock acquisition. And if ever the stock acquisition is less than 100% or not 100%. And letter D, we recognize and measure goodwill or recognize a gain from a bargain purchase, depending on whether the consideration transferred is greater than or lesser than the fair value of net assets acquired. Okay? So our main problem in your accounting for business combination is the recognition and measurement of the net asset and consideration, including the recognition of goodwill or gain on bargain purchase. Because the acquirer, it is easy to know who is the acquirer, and the acquisition date is also easy to know as long as you already had control. Our main problem is the recognition and measurement. Hence, we now proceed to our next topic or our next slide, that is your recognition and measurement rules. So take note, we need to know our consideration transferred versus our fair value of net assets. Okay. So what composes your consideration transferred? Actually, your consideration transferred is composed of the following items. First, your cost of acquisition or consideration transferred. Next, we have your fair value of previously held interest. Next, we have your fair value of contingent liability. Next, we have your fair value of non-controlling interest. This will give you your total consideration. And then we compare it to your fair value of net assets. Okay? So when we talk about consideration transferred versus FVNA, consideration transferred is composed of the following. Your consideration transferred on the acquisition. You also have your non-controlling interest. You also have your previously held interest, including any contingent liability. Okay? When we talk about FVNA, that is only the measurement of the acquired business entity. This is on the acquired business entity. Okay? So we just get the fair value of assets less fair value of liabilities of the acquired business entity. And then later, we will just compare. If the consideration transferred is greater than FVNA, we have a goodwill. If it's lesser, we have a gain on bargain purchase. Therefore, we must place our focus on how do we measure your consideration transferred, your previously held interest, your contingent liability, and your non-controlling interest. So first, on your cost of acquisition or consideration transferred. So what is this cost of acquisition or consideration transferred? So this is the amount of assets, liabilities, or equity, assets, liabilities, or equity issued by acquirer to the acquiree. That is the asset, liability, or equity issued by the acquirer to the acquiree. Okay? So how do we get for that cost of consideration or cost of acquisition? So to measure it, take note guys, that the assets transferred should be measured at fair value. Okay, so for example, A purchased B. A issued cash of 300,000 and then equipment of 900,000. But the equipment has a fair value of 1 million. Okay? So if ever we transfer anything to the acquiree, we will measure it at fair value. So what is the fair value of cash? That is the 300,000. What is the fair value of the equipment? 1 million pesos. So how much is the asset transferred? 1.3 million. Are we clear? Okay, again, on your cost of acquisition or consideration transferred, that is your asset, liability, or equity issued by acquirer to the acquiree. So whatever we gave to the acquiree, that is the amount that we will measure. Therefore, here, if we transfer any asset, how do we measure? At fair value. So if ever we transfer cash of 300,000, and we transfer equipment with book value of 900,000 but with fair value of 1 million pesos, how much is the total fair value of assets transferred? The fair value of assets transferred is 1 million plus 300,000, 1.3 million. Next, as to your liability issued. So liability issued, if we issue any liability, how do we measure it? At present value. So we measure the present value of the obligation, or also known as your fair value. Take note, guys, that present value is already discussed to you before when you finish your intermediate accounting. So you must already know how to get for the present value of the liability. Finally, we can also issue equity. So if we issue equity, how do we measure it? If we issue equity, we measure it at the fair value of shares issued at acquisition date. The fair value of shares issued at acquisition date. Okay? So when we talk about your cost of acquisition or cost of consideration transferred, we talk about these following items. So we talk about your assets transferred, which should be measured at fair value, liability issued, which should be measured at present value, equity issued, which should be measured at fair value of shares issued. Next, we get for the fair value of previously held interest. So how do we get for your fair value of previously held interest? To get for the fair value of previously held interest, just compute for the fair value of previous shares held. Okay. Sir, when do we have a fair value of previously held interest? This happens if ever the acquisition is done by step. So it's done by step or step acquisition. So what do we mean by step acquisition, sir? There is a step acquisition if ever you have a previous interest, which is less than 50%, and then you purchase another interest. So once you purchase the another interest, you have now more than 50%. So for example, A owns B, 10%. That's on January 1, 2021. Now, on August 1, 2021, A purchased 50% of B. So the previous held interest is 10%. You purchase another interest at 50%. You have now 60%. That is known as step acquisition. So you have a previously held interest, and then you purchase another interest at 50%. The purchase of another interest should be measured based on your issuance, whether you issued asset, liability, or equity. But how do we measure the previously held interest? So our main problem is, how do we measure this 10%? We measure it at fair value of previously held shares. Fair value of previously held shares. Later, we will discuss, or we will have an example as to how we will compute for the fair value of the previously held shares. Okay? So this happens only during step acquisition. Next, we talk about your fair value of contingent liability. We talk about your fair value of contingent liability. So how do we compute for the fair value of your contingent liability? We compute for your fair value of your contingent liability by first getting if ever there is a contingent liability. So what is a contingent liability again? So this contingent liability is based on the happening of a particular event in the future. So what is a contingent liability in the context of a business combination? So there is a contingent liability in the context of business combination if ever there is a future consideration, contingent liability, if ever there is a future consideration that will be given by the acquirer to the acquiree upon the happening of a certain event. Okay? So there will be a future consideration that will be given by the acquirer to the acquiree upon the happening of an event. So how do we get for the fair value of your consideration or contingent consideration or contingent liability? The fair value of contingent liability is based on its current fair value or the current estimate. Okay. And this particular estimate should be remeasured. Okay. So what is this remeasurement? So in your PFRS 3, we have this remeasurement period. This remeasurement period is 1 year from the date of acquisition. This remeasurement period is 1 year from the date of acquisition. So for example, we acquired on January 1, 2021, 1 year until January 1, 2022. This period here is known as your remeasurement period. So from January 1, 2021 up to January 1, 2022, that is your remeasurement period. Okay. So if it's remeasured or there are changes during remeasurement period, it will affect your goodwill. It will affect your goodwill. But if the changes is done after remeasurement period, it is treated as part of your profit or loss. Okay? So again, guys, on your remeasurement period, on your contingent consideration, initially, it is only an estimate or fair value. And you have 1 year to remeasure it. If it's done within 1 year, it affects your goodwill or gain on bargain purchase. But if it is not within the 1 year, it will not affect your goodwill or gain on bargain purchase, but will affect your profit or loss. Sir, why does it affect my goodwill or gain on bargain purchase? It affects your goodwill or gain on bargain purchase because again, your fair value of contingent consideration is used to compute for your total consideration transferred. And your total consideration transferred is if compared to your FVNA will give you your goodwill or gain on bargain purchase. So if there is a change on your contingent liability, there will also be a change on your contingent consideration or your total consideration transferred. Then, the change on your total consideration transferred will affect your goodwill or gain on bargain purchase. Okay? So there is a remeasurement period. What is the remeasurement period again? 1 year from the date of acquisition. We will remeasure the amount of our consideration transferred. Lastly, as part of your consideration transferred is the fair value of non-controlling interest. Fair value of non-controlling interest. So how do we get for your fair value of non-controlling interest? That is either given or you need to gross up. Okay? It is either given or it is gross up. So there are two methods on measuring your fair value of non-controlling interest. That is either your partial or proportionate method. And we have also your full or fair value method. Full or fair value method. So under your partial or proportionate, we get for your fair value of net assets of the acquiree, we multiply for the non-controlling interest. For your full or fair value method, it's either the fair value is given or we gross it up. So how does your gross up works? For gross up, we get for your total consideration given, we divide it to the interest purchased, and we multiply it to the non-controlling interest. Okay? So for non-controlling interest, how do we compute it? It's either partial or proportionate. Fair value of net assets of the acquiree, we multiply it to your non-controlling interest. Or full or fair value method, we gross up by getting the total consideration, we divide it to your interest purchased multiplied by your non-controlling interest. Okay, so let's wrap up this recognition and measurement. So what do we do? First, we need to recognize the total consideration transferred. What are the components of total consideration transferred? The cost of acquisition or consideration transferred that can either be asset, liability, or equity. Next, the fair value of your previously held interest. That is the fair value of previous held shares due to step acquisition. Next, the fair value of contingent liability or contingent consideration that is based on your fair value or estimate of contingent consideration. Next, the fair value of NCI, which is either based on your proportionate method or your full or fair value method. Okay? After knowing your consideration transferred, you compare it now to your fair value of net assets. Okay. Take note, guys, NCI and previously held interest is present only on your stock acquisition. Present only in your stock acquisition. Therefore, guys, if we will now recapitulate everything from your effects or mode of affecting your business combination up to this particular topic, what do we need to understand? We need to understand the formula in computing the goodwill or gain on bargain purchase. So how do we compute for the formula of your goodwill or gain on bargain purchase? To compute for the formula of your goodwill or gain on bargain purchase, we need to look of the type of business combination. So we either have your asset acquisition or stock acquisition. So again, we need to compare the consideration transferred to your fair value of net assets. So what are the components of your consideration transferred again? We have your consideration transferred plus fair value of previously held interest plus fair value of contingent consideration or contingent liability plus fair value of non-controlling interest. This is your total consideration. How about in your asset acquisition? In your asset acquisition, what is only present is the the consideration transferred itself, plus your fair value of contingent liability or contingent consideration, total consideration. In short, guys, fair value of previously held interest and non-controlling interest is only present on your stock acquisition. They are only present on stock acquisition, but not on asset acquisition. Okay? So we already discussed the recognition and measurement rules on your consideration transferred, acquired business entity, non-controlling interest, and previously held interest. On your acquired business entity, what do we call this one? This is your fair value of net assets. It is known as your fair value of net assets. Now we go to the last item of your recognition and measurement rule. These are your acquisition costs. Okay, so what are acquisition costs? So this is not considered your consideration transferred, but it is your cost of effecting business combination. So this is composed of your direct business combination costs or direct costs. This is again composed of your indirect business combination costs. Okay. So whether it is a direct attributable cost or indirect attributable cost, what is the treatment? We should expense it. Direct or indirect business combination costs should be expensed. But if there is cost of issuing securities, sir, what is your cost of issuing securities? Remember, a while back, we can issue your shares of stock. So the cost of issuing the shares, you should deduct it to your share premium. So any share premium, so it will be reduced by your cost of issuing the shares. If not enough, it is treated as part of your retained earnings, considered also as an expense. Okay? So again, on your acquisition costs, these are your costs of effecting the business combination. We have your directly attributable costs or your direct business combination costs, indirect acquisition costs or indirect business combination costs. These are treated as expense. Your cost of issuing securities, they are treated as a reduction to your share premium. But if your share premium is not enough, it is treated as part of your retained earnings. So we're done discussing your recognition and measurement rules. So we can now try to apply this recognition and measurement rules. So we go now and try to solve some problems regarding what we learned about your recognition and measurement rules. So first, on your consideration transferred, in the first problem, XYZ company purchased ABC company by issuing cash of 3 million pesos and equipment with a cost of 2 million, carried in the books at 1.2 and has a fair value of 1.5 million. How much is the consideration transferred? To answer this particular problem, we need to go back to what we have learned a while back. So for the consideration transferred, we have the following items that can be issued. That can either be an asset, it should be measured at fair value. That can either be at liability, measured at the present value of the obligation, and that can either be the equity, which is also known as your fair value of your equity. So here, what are the items transferred? Purely asset. So we have here cash, which is transferred. Another that is transferred is your equipment. What is the fair value of cash? 3 million pesos. That is the amount of your cash. The face value is also the fair value. How about the equipment? What is the fair value of the equipment? 2 million pesos? No, that is the cost. The fair value is 1.5 million pesos. So the total consideration transferred is equal to 4.5 million pesos. Okay, next. XYZ company purchased ABC company by issuing cash of 2 million and issuing its own 100,000 shares with par value of 20 and fair value of 30. How much is the consideration transferred? We go back to our rules. If that is an asset, measure it at fair value. Liability, measure it at present value. Equity, measure it at fair value. So what are the items transferred here? Asset and equity. So what is the asset transferred? Cash of 2 million pesos. What is the equity transferred? Its own 100,000 shares. Par value is 20, fair value is 30. So how do we measure the equity then? So the equity should be measured at fair value. The fair value is 30. How many shares? 100,000. 30 times 100,000 will give us 3 million. So 2 million plus 3 million, the, the consideration transferred is 5 million pesos. Okay? Nakakasunod? Okay. Next slide. Example of consideration. Contingent consideration. Okay, guys. So part of your total consideration transferred is your contingent consideration, right? So we have your consideration transferred initially, plus your contingent consideration or contingent liability, plus previously held interest, plus your non-controlling interest. So we go back to what we have learned in your contingent consideration. Your contingent consideration should be measured at its estimate or fair value. Further, this estimate or fair value should be remeasured. So when do we remeasure this estimate or fair value? We remeasure this estimate or fair value within 1 year. This within 1 year is known as your remeasurement period. Remeasurement period. So if ever it is within the remeasurement period, it affects your goodwill or gain on bargain purchase. Why does it affect your goodwill or gain on bargain purchase? It affects your goodwill or gain on bargain purchase because, again, your consideration will change. Now, what if it is outside your remeasurement period? If it's outside your remeasurement period, what do? We place it as part of your profit or loss. Therefore, it will not affect your goodwill or gain on bargain purchase. So let's try to solve this problem. Now we have here a consideration transfer that is part of your contingent consideration. We already know how to measure it. That is the estimate or fair value. So on January 1, 2020, XYZ company purchased ABC company by issuing cash of 2 million and its own share of 100,000 with par value of 20 and fair value of 30. It was further agreed that XYZ would pay an additional amount on January 1, 2022 if the average income during the 2-year period of 2020 and 2021 exceeded 1.6 million per year. The expected value of this consideration was calculated as 2,680,000. So if ever we talk about your consideration transferred, take note, it is part of your consideration transferred asset, liability, or equity. We add your contingent consideration or contingent liability, including PHI and NCI. In this case, the total consideration transferred is only composed of the consideration transferred plus the contingent consideration or contingent liability. So for the consideration transferred, we're done computing that. That is the cash of 2 million pesos plus the fair value of your shares, 30, and the 100,000 shares. So this will give us 5 million pesos. So consideration transferred is 5 million. And the contingent consideration should be measured at its estimate or fair value. And what is the estimate? The expected value of the consideration is 2,680,000. So we place here as part of our contingent consideration or contingent liability, 2,680,000. So how much is the consideration transferred? 7,680,000. Next, we answer number 2 on this example. Using the same information above, assuming that on August 1, 2020, the contingent consideration happens to be 3.4 million. What is the consideration transferred? Okay, so again, we need to look whether it is within the remeasurement period. What is the remeasurement period? Within 1 year. So we get first the acquisition date. What is the acquisition date? On January 1, XYZ company purchased ABC company. So our acquisition date is January 1, 2020. Within 1 year, that is until January 1, 2021. Now, there is a remeasurement on August 1, 2020. Should we remeasure it? Yes, because August 1, 2020 is within the remeasurement period. Therefore, consideration transferred of 5 million plus the contingent consideration remeasured now at 3.4 million. What is the total consideration? 8.4 million. 8.4 million. Okay? So what happened here, guys? Again, it is within the remeasurement period. So from January 1, 2020 to January 1, 2021, pasok yung August 1, 2020. Therefore, we need to change our contingent consideration. How about on number 3? So here in your number 3, using the same information, however, on January 15, 2021, the contingent consideration happens to be 3.5. So January 15, 2021, question, is it within the remeasurement period or not within the remeasurement period? Not within the remeasurement period. Therefore, what will happen? If that is not within the remeasurement period, the value of the contingent consideration will remain the same. So if our consideration transferred initially is 5 million and our contingent consideration will remain the same at 2.68 million because again, it is already outside the remeasurement period. What then is our answer here on your total consideration transferred? It is 7,680,000 pesos. 7,680,000 pesos. So here in number 2, it is within. In number 3, it is outside. Take note, if it is within, we need to change the value of your consideration transferred. So it's now 3.4 million. But if it's outside, we will not change the value of our consideration transferred. Okay? So that is for contingent consideration. Let's proceed. We go now to your acquired business entity or your FV&A. So how do we determine your fair value of net assets again? Just get the fair value of the assets of the acquired entity and you just get the fair value of the liability of the acquired entity. So John Corporation concluded that the fair value of Carlo Company was 80,000 and paid that amount to acquire all of its assets. So who is John here? John is the acquirer because John purchased Carlo. Carlo then is the acquiree. Carlo reported assets with a book value of 60,000. So assets of Carlo is 60,000, fair value is 98. Liabilities book value and fair value is the same, 23,000 pesos. Okay, now first question is what is the consideration transferred? So if we try to look at it, John purchased Carlo for 80,000 pesos. So the consideration transferred is 80. How about the fair value of net assets? So we just need to get for the fair value of assets of the acquired entity, which is the acquiree, and the liability, fair value of the liability of the acquiree. Fair value of assets less fair value of liability will give you your fair value of net assets. Okay, so what is the fair value of assets of Carlo? So he is the acquiree again. Acquiree is Carlo. So the fair value of assets of Carlo is 98,000. And the fair value of liabilities of Carlo is 23,000. So what is the net asset of Carlo? 98 less 23, the FB&A is equal to 75,000 pesos. Okay, so for FBNA, it is quite easy. You just need to deduct out of the assets the liability. So just to remeasure the assets of the acquiree at fair value, remeasure the assets of the liability of the acquiree at fair value. Okay. Next, FVNA still. On April 1, 2017, Carlo Corporation paid 620,000 for all of the net assets of John Company. The recorded assets and liabilities of John Corporation On April 5, 2017 follows. You have your cash, inventory, PPE, goodwill, and liabilities. On April 1, 2017, Jan inventories had a fair value of 150. So we need to change here 150. And the property, plant, and equipment has a fair value of 380,000. Now, guys, if ever this is an acquired business entity, you cannot acquire goodwill. You cannot acquire goodwill, so this will be zero. How about cash? Cash will still remain at 60,000. So what is the fair value of asset of Jan? 60 plus 150 plus 380, we have 590,000. And the liabilities, the fair value of liabilities is 120,000. Therefore, the fair value of net assets, 590 versus 120, we will have 470,000 pesos. So we are ready to answer this problem. What is the consideration transfer? Take note, Carlo, page 620 for Jan. Carlo is the acquirer. Jan is the acquiree. So for Jan, being the acquiree, we need to get for the fair value of its net assets. So consideration transferred, 620,000. Fair value of net assets, 470,000. Okay? Next. Another FVNA problem. The Mark company had these accounts at the time it was acquired by Francis company. So Mark is acquired. Therefore, Mark here is the acquiree and Francis is the acquirer. So the following are the accounts of Mark: cash, AR, inventory, property, plant, and equipment, and accounts payable. So Francis Company paid 2.8 million for net assets of Mark Company. It was determined the fair market values of inventories and PPE were 260 and 1.8. So inventory is 260,000 and PPE is 1.8 million. An assumed contingent liability arising from past event, so paid 2.8, and there is a contingent liability arising from past events with fair value of 20,000. What is the consideration transferred and what is the FVNA? So let's answer first the FVNA. Okay, so of course the cash will remain as 72,000. AR, since there is no other news or there is no other info regarding the value of AR, it will remain at 914,000. Inventories at 260,000 and your PPE at 1.8 million. So what is the fair value of assets? 72 plus 914,000 plus 260,000 plus 1.8 million will give us 3,046,000. I think this is 66, 266 pala yung inventory. Let's recompute. 72 plus 914 plus 266 plus 1.8 million. We have 3,052,000. Okay? So this is 3,052,000. Next, the fair value of liability. There being no other evidence for fair value of liability, it will remain as 701,600. So what is the fair value of net assets? 3,052,000 less 701,600. We will have 2,350,400. Okay? Next, consideration transferred. So when we talk about consideration transferred, what are the items again? So the consideration itself, plus contingent liability, if we have any contingent liability, plus previously held interest, plus non-controlling interest. So how much is the consideration? Francis paid 2.8 million. So 2.8 million, that is the consideration. Next, contingent liability. We have the contingent liability that is 20,000. So how much then? There's no previously held interest. There's no non-controlling interest. How much is the consideration transferred? 2,820,000. 2,820,000. Okay? Next, we talk about your acquisition cost. Okay. We said that your direct acquisition costs and your indirect acquisition costs are expense. How about your stock issuance cost? Your stock issuance cost will decrease the share premium. But if share premium is not enough, what do? We place it as part or reduction of retained earnings. Okay? So if share premium is not enough, it is considered as a reduction to retained earnings. Okay, so if you are presented these items, you just need to first know the stock issuance. Anything that is treated for stock issuance should be part of stock issuance cost. So stock issue, this is stock issuance cost. Stock certificates, stock issuance cost. Listing new shares is stock issuance cost. So these three items are stock issuance cost. So how much is the total stock issuance cost? Stock issuance cost is equal to 90,000. The audit fee for SEC registration of stock issue, 90,000. The printing cost of stock certificates, which is 14,500. And then we have listing fees in issuing new shares, 36,000. So total stock issuance cost is 140,500. And how about the other items? They are already considered as direct or indirect acquisition costs. So legal fees for contract of business combination, this is part of your expenses. So here, 35,600. Broker's fee, 23,600. Accountant's fee for pre-acquisition audit, 80,000. Other direct costs, 75,000. General and allocated expenses, 43,000. So all other items that is not considered or connected to your stock issuance is considered your direct or indirect acquisition cost. So how much is the total direct or indirect acquisition cost? 35,600 plus 23,600 plus 80,000 plus 75,000 plus 43,000 will give us 257,200. So the 257,200 being direct or indirect is expense. Now we go to your stock issuance cost. What is the rule? If ever the share premium is enough, it will decrease the share premium. But if it's not enough, the other is treated as reduction in retained earnings. Okay, so assuming the share premium on issuance is 300,000, what is the net share premium to be presented? So our share premium on issuance is 300,000. Our stock issuance cost is 140,500. Is our share premium enough to carry our stock issuance cost? Yes. Therefore, you will reduce the share premium. So 300,000 plus 140,500, 159,500. Next question. Assuming the share premium on issuance is 100,000, what is the net share premium to be presented? So if our share premium is 100,000 and we have 140,500, is our share premium enough? No. So what do? We will present share premium at zero kasi nga magagamit na natin yung buong 100,000. What will happen to the excess of 40,500? This will now decrease your retained earnings. Take note, as a general rule, stock issuance cost will decrease your share premium. But if your share premium is not enough, any remainder will decrease your retained earnings. So in our example, we took a look as to whether a particular cost is considered direct or indirect acquisition cost or stock issuance cost. Take note, it is considered a stock issuance cost if it is connected to any issue of stock. Then, any remainder is known as your direct or indirect acquisition cost. So your direct and indirect acquisition cost that is used to affect the business combination is expense. We have already computed that at 257,200. Now, what will we do as to your stock acquisition cost? Your stock issuance cost will decrease your share premium, and any remainder will decrease your retained earnings. So in this case, if we have 300,000 share premium, we have 140,500 stock issuance cost. Is the 300 enough? Yes, so it will decrease your share premium, 159,500 na lang yung net share premium. But if the share premium is 100,000, and then we have a stock issuance cost of 140,500, 500. So 100 less 140, 500, we have here 0 net share premium because the share premium is not enough. What will happen to the excess? The excess will be treated as a reduction to retained earnings. Next, we compute your non-controlling interest. Okay, so part of your acquisition or consideration transferred, we have the following, right? Consideration itself, plus contingent consideration or contingent liability, plus non-controlling interest, plus previously held interest. So we're done with the two, the consideration and the contingent liability or contingent consideration. We go now to your NCI. A while back when we first discussed, we said that your NCI can be measured in two ways, and that is either your full or gross up or your fair value method, and then we have your partial or proportionate. So in your full or gross up, if fair value is given, and sabi fair value, use fair value. If the fair value is given and the problem states that use fair value, use fair value. If fair value is not given and the problem say use full or gross up, then gross up. Okay? So for full or gross up, if the problem will say full or gross up, full or gross up. If the problem will say fair value, use fair value. Sir, what if fair value, but the fair value is not given? Use gross up. Okay? Because the three are interchangeable. Again, if the problem says fair value, use the fair value. If no fair value, you can gross up. You can gross up. If the problem says gross up, but there is fair value, use gross up. Clear? And if the problem says partial or proportionate, use partial or proportionate. Okay. So Pine Company acquires 75% of Shine Company's common stock for 6,320,000 cash. At that date, Shine Company reports identifiable assets with book value of 7.8 and fair value of 10.2, and liabilities with book and fair value of 3.8. The fair value of the 25% non-controlling interest in Shine Company is 1.8 million. So what is the consideration? The 6,320,000 cash. What is the FVNA? What is the fair value of assets of Shine? We have 10.2 million. And what is the fair value of liabilities of Shine? We have 3.8 million. So what is the FVNA? 10.2 million less 3.8 million, we have 6.4 million pesos. Okay. Now we're ready to compute. First, what is the NCI if the NCI is measured using partial or proportionate? Okay. To compute for your partial or proportionate, we get first for the FVNA, we multiply it to your non-controlling interest. So what is the FVNA? 6.4 million pesos. What is the NCI? 25%. So what is the value of the NCI? So 6.4 million times 0.25 will give us 1.6 million. So our answer, what is the NCI if the NCI is measured using partial or proportionate method? 1.6 million pesos. Next, what is the NCI if the NCI is measured using full or gross up method? So if that is full or gross up method, what do? We get first for the consideration, we divide it to your controlling interest purchase. So this is your total value. You multiply it to your NCI, we will get the value of NCI. Okay. So what is the consideration transferred? 6,320,000. What is the interest purchase? So Pine Company acquires 75% of Shine Company. So our controlling interest purchase is 75%. So 6,320,000 divided by 75% will give us 8,426,667 multiplied by your NCI percentage, 25%. So our NCI is 2,106,667. So what is the value of the NCI if using full or gross up method? 2,106,667. Next, what is the NCI if the NCI is measured using fair value method? If fair value method, I told you, just use the fair value given. So what is the fair value given? The fair value given as to your NCI, sabi dito, the fair value of the 25% NCI is 1.8 million. So our answer is 1.8 million. Okay. So there are three methods as to your estimation of your non-controlling interest. We discussed your partial or proportionate. We just multiply the NCI percentage to your FVNA, the full or gross up method, and then we have your fair value method. Okay. Guys, if we try to combine what we have learned initially and including NCI, if the question is total consideration, if the question is total consideration, how do we compute again? Your total consideration is equal to, first, we need to compute for the consideration given plus any fair value of contingent consideration or contingent liability plus any value of previously held interest plus any value of NCI. So in our example, guys, let's compute for assumption number 1. What is the amount of consideration? 6,320,000. Is there any contingent consideration? None. Is there a previously held interest? None. Is there an NCI? So using assumption 1, what is the NCI? 1.6 million. So what is the total consideration? 7,920,000. So we will just need to add it. How about for assumption 2? What is the consideration? It will still remain as 6,320,000. Contingent consideration or contingent liability is 0. Previously held interest is 0. So what is the NCI under assumption 2? Under assumption 2, our NCI is 2,106,667. So what is the total consideration? Our total consideration is 8,426,667. Okay? So you just need to place in your formula the NCI value that you have computed. So you just need to master how to compute for the proportionate, the full or gross up method, and then your fair value method. Okay? So we're almost done. We already discussed FVNA. We discussed your consideration itself, contingent consideration, non-controlling interest, and your acquisition cost. We are now down to our last topic, that is your previously held interest. Okay, so a while back we discussed already your previously held interest. We just need to get for the fair value of previously held interest. Previously held interest happens only during step acquisition. What is a step acquisition again? A step acquisition happens if ever, guys, that we have previously held an interest, and then we purchase another interest which gives us control. So let's have an example. On January 1, Tatak acquired 15% ownership in COA for 400,000. The investment was accounted for under PFRS 9. From 2017 to 2019, Tatak recognized net fair value gains of 200,000. On January 1, 2020, Tatak acquired additional 60% ownership interest in COA for 3.2. So before 15%, you purchase new interest of 60%, you have now 75%. So what do we do? This previously held interest should be measured at fair value, and the 60% should be measured at its consideration. Okay, so what is the Value of the previously held interest, sabi natin, fair value. So the 15% has a fair value of 720. So our answer here is 720,000. So what is the consideration transferred? So if you look into your consideration again, it is your consideration plus contingent consideration plus previously held interest plus non-controlling interest. So we already know our consideration. We have here 60%. The 60% was purchased for 3.2 million. Do we have any contingent consideration? None. Do we have a previously held interest? Yes. What is our previously held interest? Valued at 720,000 pesos. Do we have NCI? Yes. Sir, why is there an NCI? There is an NCI, guys, because we only own 75%, right? This is our ownership. So we have an excess of 25%. So this 25% is the NCI. So using the problem, can we use proportionate? No, we cannot use proportionate. Why? Because the FVNA is not given. Can we use gross up? Yes, because we know the consideration. What is the consideration given? 3,920,000. We divide it to, okay, 3,920,000. That is the consideration. We divide it to your controlling interest, 75%. So how much is the value? 3,920 divided by 75%. We have 5,226,667 multiplied by your NCI percentage of 25%. So times 25, we have 1,306,667. So this is 1,306,667. How much is the total consideration? 3.2 million plus 720,000 and 1,306,667. So this will give us 5,226,667. Okay? So here, guys, although we have a previously held interest, at the same time we have an NCIY, 15% ownership initially, you purchase 60%, you have now 75% ownership. Because you only have 75% ownership, you have an NCI. Take note of that. If the ownership that you purchase is less than 100%, there will always be an NCI. Okay? You will not be asked what is the NCI, but you need to know if there is an NCI or not because it is included in our computation. Okay, so we're done with your uh, recognition and measurement as to your consideration and your fair value of net assets. Since you're already done, we can already recognize the difference between the consideration transferred. So if the FVNA is less than consideration transferred, it is goodwill. Or in short, if the consideration transferred is greater than FVNA, it is goodwill. If the consideration transferred is lesser than FVNA, it is gain from bargain purchase, or if the FVNA is greater than consideration transferred. Therefore, guys, you need to always take note what are the treatments on your consideration transferred. What are the items again? Consideration transferred is composed of your consideration itself plus contingent consideration plus your previously held interest plus your non-controlling interest. FVNA, you just need to get for the fair value of assets of the acquiree less the fair value of liabilities of the acquiree. You compare both, you can get goodwill or gain from bargain purchase. For next meeting, we are now ready to compute for the goodwill and the gain from bargain purchase. Okay, you just need to compare the two. That's it for this session. We will continue next meeting.